Will investing in the Max Life Flexi Wealth Plus policy help you cater to your dual needs of providing your family with financial safety in case of your unfortunate absence and also the responsibility of fulfilling the financial dreams of your family? Let us find out the answer to this question through an in-depth analysis in this video. Hi, welcome to holisticinvestment.in. We help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. Now, before analyzing this policy, let us first understand what is this policy is about. So, this is a unit-linked, non-participating individual life insurance plan. Some of the key features of the policy are you have options to choose from. Like there are two variants to choose from as per your needs, and you also have the option to choose your policy term and premium payment term at your convenience, and you have a wide range of 16 funds and 5 investment strategies to choose from. And there are also guaranteed loyalty additions and guaranteed wealth boosters which will enhance your fund value, and all the mortality charges you have paid during the policy term are returned at maturity. And there are unlimited free switches and 12 free partial withdrawals which are allowed in a year. So these are the key features of the policy, and there are also two variants. First is a wealth variant and another one is a whole life variant, and there are 5 strategies which are self-managed portfolio strategy, the systematic transfer plan, life cycle based portfolio strategy, trigger based portfolio strategy, and finally dynamic fund allocation and DFA strategy. It also has 16 fund options which are high growth, nifty small cap, quality index fund, mid cap momentum index fund, diversified equity, Nifty Alpha 50 Fund, Nifty 500 Momentum 50 Fund, Growth Super Fund, Growth Fund, Sustainable Equity Fund, Pure Growth Fund, Balance Fund, Conservative Fund, Dynamic Bond Fund, Secure Fund, Secure Plus Fund, and Money Market 2 Fund. So as you can see in this tabular column, all these fund options are categorized based on the percentage of allocation each fund option has to certain asset classes like government securities, corporate bonds, money market and cash instruments and equities. And it is also categorized according to the risk profile each fund option has, which can range from low to medium to high and to very high. And this policy has other benefits like death benefit, which the policyholder's nominee or the legal heir will get in case of the unfortunate death of the policyholder during the policy term. And maturity benefit is something the policyholder will get once the policy matures. And there is also survival benefit. When the premium payment term is finished, this benefit will be given to the policyholder. And there are other benefits like switching, premium redirection, partial withdrawal, increase or decrease in premium payment term or policy term, settlement option, premium redirection, and additional rider benefits. And after all this, there are also various charges that they impose on you for investing in this policy, which are premium allocation charge, policy administration charge, fund management charges, mortality charge on death benefit, surrender or discontinuance charges, switch charges, premium redirection charge, partial withdrawal charges, miscellaneous charges. So the thing is, all these charges are only not essential. Like some of the charges might be essential, but most of these charges are not essential to run the plan. So essential charges like mortality charge, something like that, or fund management charges, but most of the other charges weigh down your investment return like premium allocation and policy administration charge and other charges. The thing is, all these charges will bring down significantly your returns in the long run. So you need to keep this as a drawback in your mind before deciding to invest in this policy. And if you want to know more about all these aspects of this plan in detail, you can refer to the policy brochure. So some of the advantages of the policy are you have the option to choose from 2 variants, 5 investment strategies and 11 funds. And there is also guaranteed loyalty addition and guaranteed wealth boosters available to increase your fund value. And they also return your mortality charges, and you get unlimited free switches, 6 premium redirections and 12 partial withdrawals which are allowed in a policy here. And you're allowed to increase or decrease the premium payment term or policy term. term, and the settlement option can be exercised during maturity. So these are some of the advantages. The disadvantages, however, are there is no liquidity in the first 5 years of the policy. The loyalty addition starts from the 6th year and wealth booster starts from the 11th year onwards only, and there is no loan facility available. And during the settlement period, the investor should bear the investment risk. So these are some of the drawbacks that you need to keep in your mind before deciding to invest in this policy. Now, as we have a basic understanding of this policy, let's move on to the analysis part of the video, where beyond the features and benefits of the policy, we need to know what kind of returns we get in hands at the end of the day to help us make an informed decision. That's why we are going to calculate the internal rate of return, IRR, of this policy based on the benefit illustration given in the policy brochure. Now, for calculation purpose, let us assume that a policy holder of 35-year-old male is going to purchase this policy with a premium payment term of 5 years, policy term of 10 years, and sum assured of 10 lakhs. So the annualized premium is 1 lakh, and he has chosen a balanced fund, and the variant is wealth variant. So as this is a ULIP policy, to indicate the worst and best case scenario, the fund value is going to be have an assumed rate of return of 4% and 8% rate of per annum. This is just for example. So at the end of 10 years at 4%, worst case scenario, the maturity benefit would be 5,56,594 rupees, and an assumed rate of 8% in the best case scenario, it will be 7,60,100 rupees. So the IRR for the 4%, like the worst case scenario, is 1.35%, and the best case scenario IRR, which is the 8%, is 5.34%. So this proves that this policy couldn't even reap a bank savings account return at 4% and couldn't even reap a bank FD rate at 8%, which makes it difficult to beat inflation in the long run. So now, as we know that this policy is not giving us a desirable outcome we need, now we are going to explore an alternative strategy where we are going to invest in insurance and investment separately instead of investing in an insurance cum investment policy like the Max Life policy. We are going to see whether investing separately would help us get better returns and will they perform efficiently in isolation. So here what we are going to do is, for calculation purpose, for life cover especially, we have taken up a pure term insurance policy with a sum assured of 10 lakhs, a policy term of 10 years, and a premium payment term of 5 years. So we have taken up similar metrics for a fair comparison. So the annual premium for this policy would be 7,700 rupees. So compared to Max Life policy, here we are saving 92,300 rupees, which could be invested separately based on a risk profile. So as we are comparing with the ULIP policy, which has market risk, for a fair comparison, we have also taken up investing in the mutual fund ELSS fund. So ELSS fund also has market risk because it is an equity linked savings scheme. So here, if we at the end of 10 years, the fund value, which is the post tax, would be 10.86 lakhs. So the IRR would be, the post tax return would be 10.06%. So this is beneficial to the investor in the long run as the return is higher than the inflation rate. If you have any doubts regarding how the ELSS tax is calculated, we do have a small tabular column presented on the screen for your reference, which you can pause and see. So in this alternative strategy, what we understand is it gives you better returns and better liquidity compared to Max Life policy. Then what is the final verdict? Like, will investing in the Max Life Flexi Wealth Plus plan worth it or not? So this new scheme from Max Life will enable you to have flexibility in terms of the policy term, investment strategy, and also fund options. Since this is a ULIP, it also has some complex charges and is not very transparent in its operation. The crucial factor of how you get low IRR is mainly because of charges which get deducted before being invested in the fund, yielding you low returns. Overall, we can conclude that investing in a ULIP like Max Life Flexi Wealth Plus plan has some pros and cons. If you're willing to take the risk, then you have much better market related instruments in the market rather than investing in the Max Life policy. You can invest in mutual funds that cater to your needs and also suits your time horizon. Any insurance scheme which provides a combination of dual benefits will not be able to help you generate inflation beating return that you're looking for. So it is better to keep both your insurance and investments separately to potentially yield better returns in the long run.
If you want to read more about this policy, then you can definitely check out the blog post we have posted hosted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.